Lemonade released their latest quarterly figures, a pretty good quarter, another quarter of net cash flow positive, and right now at the time of making this video, the stock is up 30%. Now as you can see right here, back in July, the stock was already up close to 45%, and then a couple of weeks later, it gave away all of its gains for the year. Do I think it's going to happen yet again? No, because the company keeps proving to Wall Street that its business is actually working. It's actually working out and doing better than what was expected, plus guidance this time was raised. Last time that was not the case, was just reiterated. Right now, this is a company with a market cap of $1.73 billion. Year over year, the stock is up close to 130% right now, still overall not profitable. Then if we look at what the analysts are expecting sales-wise, we can see that analysts are expecting for fiscal 2024 sales growth of 19.49%, followed by an acceleration 27.76% growth year over year in 2025, and then 24.17% year over year growth in fiscal year 2026. And so if you look at EV to sales in the next 12 months, that sits at 2.4 times. So let's dive a little bit deeper, shall we? If you enjoy this type of videos, give it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So the big overview here is brought to you by Stock Market Nerd, not sponsored, just a great guy on X. So for the quarter, beat across the board, beat gross earned premium by 1.9%, revenue estimate by 8%, and beat guide by 9.3%. As for EBITDA estimate, still negative, of course, loss $56 million, but that beat by $7 million and beat guide by $8 million. As for Q4 guidance, Q4 revenue guide was met. Q4 EBITDA guide missed by $6 million, but they did raise annual revenue and gross earned premium guides due to large Q3 beats. So overall, that's the big picture, year over year, quarter over quarter, and on a 2-year CAGR. So for this quarter, in-force premium increased 24% year over year to now $889 million for the period ending. Then premium per customer is now at $384. That's up just 6% year over year. Total customers increased 17% year over year. As for gross loss ratio, that continues to go down 73%. As for cash flow, they said we once again delivered net cash flow positive quarter, generating $48 million of net cash flow. Cash flow from operations was positive in the third quarter at $16 million. We reiterate our expectation of sustainable net cash flow positivity exiting the year. That's great, and probably also one of the main reasons why the stock is up so much. As for gross profit, that increased by 71% year over year to $38 million, while their gross profit margin increased by 8 points year on year to 27%. Operating expense did increase $26 million or 27%, primarily driven by a $27 million increase in growth spend, consistent with our plans to accelerate investment pace this year. They said that last quarter, I think it's going to be 3x of last year, Q3 and Q4. They say excluding growth spend, operating expenses were unchanged year on year. Bottom line, primarily due to nearly 3x increase in growth spend referenced above, adjusted EBITDA loss of $49 million was 22% larger relative to the last year, while net loss at $68 million was 10% larger. Now again, this growth spend, this and that, you just have to look at sales and marketing, right? It has to be included in that full picture. Now, they did yet again talk about the cat exposure. So the third quarter saw elevated cat-related losses across the industry. Alongside tragic loss of life, we spoke last quarter of various initiatives we have pursued related to managing cat exposure, including geographic diversification, product diversification, introducing partners with whom we place premium in certain regions, and targeted non-renewals in cat-exposed areas. And that definitely helped them this quarter. Diversification has been an extremely powerful tool in driving resiliency in our model, enabling us to deliver sustained sequential improvement in the gross loss ratio, notwithstanding a punishing cat season. In the past 10 quarters, the in-force premium share of our relatively less cat-exposed business, for example, pet, car, and Europe, has roughly doubled from 23% to 44%. Indeed, had we not pursued diversification during this period, the cat impact to our gross loss ratio in Q3 would have been roughly 40% greater. They then also talk about the operational efficiency. So as you can see here, in-force premium per headcount has basically more than doubled since Q4 of 2021. If you look here at in-force premium versus OPEX excluding gross spend, to be honest, I mean, yes, okay, this is great to see, but excluding gross spend to me just doesn't make much sense, right? You are spending for growth, which leads you to better number and which leads you to growth year over year. So excluding that, okay, it might be 1 time, 2 time, 3 time thing, but you have to calculate it in the overall number. I just don't like to see this, oh, excluding gross spend. This is not the way to look at it, just in my opinion. They also say here, in the fourth quarter and beyond, our strategy remains consistent. We will continue to acquire profitable new business with acceleration unlocked via our synthetic agents program and increasingly leaning in on car. Simultaneously powered by our technology's unique ability to drive operating efficiency, we will continue to deliver stability in operating expenses. The outcome, accelerating growth, positive net cash flow exiting this year, and adjusted EBITDA profitability on track during 2026. We look forward to the opportunity to tell you more about these teams in a couple of weeks at our Investor Day in New York City. So, okay, I mean, so far, so good. So, if we then look at the bigger picture right here. First of all, with regards to net loss. So, net loss is now increasing for 1, 2, 3 quarters in a row. Then if we look at the expenses one, so total expense did increase year over year. The big increase comes from sales and marketing, which, to be honest, they announced it, so no surprises there. G&A did decrease year on year. Then looking at some other metrics here. So we've got annual dollar retention, so that has increased, but this quarter is a bit lower than before. Okay, 87, 88%, we'll give them that, but for the long run, you should be in the 90% range. In-force premium continues to go up, premium per customer continues to go up, although we did get a small dip here quarter over quarter, but we did get more information with regards to the different businesses, the different policies that they offer. So we're going to look at that in just a second. But overall, yes, expenses did increase quite a lot year over year because of sales and marketing, basically more than doubling year on year. As for guidance, we are increasing full year guidance for gross earned premium and revenue and reaffirming guidance for full year 2024 for all other metrics. So this is basically the picture that we're getting right now. For Q4, they expect in-force premium between $940 and $944 million, gross earned premium between $222 and $225 million, revenue to come at $145 million at the midpoint, and adjusted EBITDA loss around $27 million. For the full year, in-force premium to come between $940 and $944 million, gross earned premium around $824.5 million, revenue $523 million at the midpoint. Now, with regards to the gross loss ratio, they give us here now a better breakdown, in my opinion. So we can see that that has been improving quarter over quarter. Now we also get to look a little bit deeper with regards to the type. So homeowners, pet, car, Europe, gross loss ratio by type. We can see that, the big part for them is car, although it is trending down. Car is still at 92%. Europe, this is for all products, is also at 92%. Pet in the last 2 quarters did increase, right? We were at 63% 2 quarters ago. We're now at 71%. Homeowners continues to go down, so that's great. As for in-force premium per type, we can see homeowners is the biggest one for them. And then you've got pet that has increased also quite nicely. Car is trying to stabilize a little bit. Then you've got Europe, which is extremely small for them. Now, looking at the premium per customer, you can clearly see why car is important, right? If they can figure out the gross loss ratio for car, it's going to be very lucrative for them. Because as you can see here, premium per customer for car is just so much bigger than the others. Much bigger than homeowners, bigger than pet, bigger than Europe. That's really not that difficult. But yeah, at $1,751 compared to pet, which is $712, which has increased for a long period of time now. Homeowners at $266. You can understand why figuring out how to make car work makes sense. And I'll actually remove myself for a second here. Plus, you can see here net cash flow. Although the company from an EPS perspective, right? Still unprofitable. Net cash flows is what you want to see go up and up and up each and every quarter. And eventually you're going to see the underlying, well, EPS basically being profitable. And so right now on the weekly, what do we get? Well, we got that huge green candle right now above $25, which I hope we can stay above it, because like I said previously, we did see the same type of action previously, right? We were close to $25, then went back down. Back here, July, close to $25, we went back down. This time we are actually above it. So let's try and stay that way. On the weekly, we're not even overbought just yet. RSI is high, but not overbought. So overall, good quarter by LMND. They're on track. They're delivering. Yes, it's always about the language of the letter to shareholder, right? They're trying to word it in a way that everything looks rosy. No pun intended, because their color is rose, but pink, sorry. So yeah, overall, they are spending more, they are growing more, but hey, cash flow positive, net cash flow positive. So that's all good. Until something changes drastically on the way down, I don't see why I should turn bearish on this stock. So overall, that's all I've got for you right now. Do share your thoughts down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.